this is one of the lenders that we use, and I know a lot of people have been asking, what if their clients, or if you're a client yourself, what if you can't qualify for your regular traditional mortgage loans, right? What if you're a business owner and you write off a bunch on your tax returns, and then technically, yes, you make money, right? You have money that comes to your account, but on paper, you do not have any qualifying income, right? It's like what we call it here is that we're only going to use the income that we see that you're paying taxes on, right? Everything else is written off. We cannot use as qualifying income. So what happens is a lot of business owners feel that they can't purchase a home even though they have a lot of cash on them. So this is where the non-QM mortgages come into play. So I'm gonna make this quick video on some of the products that this specific lender offers. Keep in mind, as a broker, I have options to 20 plus different lenders, right? But this lender just have everything. They have everything down packed into some of the most important non-QM products that they offer. I'm gonna go through them. I won't go into the weeds of it, but if anybody has any questions on them, or wants to see if that their client qualifies for it, or even if you qualify for it, let me know. Shoot me an email, shoot me a text. We could work something out. So diving straight into it, the lender here is called Acra. Okay. So the first product I do want to discuss is the Investor Cash Flow DSCR. So I'm sure people have heard the term DSCR before. It's in the non-QM space, I hate the word sexy, but it is a sexy word that people just like to use. So it stands for Debt Service Coverage Ratio Loan. So essentially, the way you want to think about this loan is, if you're an investor, okay, and you're purchasing a property solely to rent it out, right? Your main goal is when you're buying that property, in your mind is, hey, I want to rent out this property, right? With this loan, we're not looking at any income documents, right? I don't care about your tax returns. I don't care about your W-2s, pay stubs, whatever, right? The lender, the person that's going to be purchasing this loan, all they want to make sure is that they're going to get paid back. So the way that they confirm, right, or have some reassurance that they're going to get paid back, aside from looking at your income docs, they're going to make sure that you're buying the right property. Okay, they're going to make sure that you're buying a property that's cash flowing and making money. So it's a win-win, because this lender is going to be doing their due diligence as well to make sure that the property that you're purchasing is cash flowing. So the way they do that is with, again, the DSCR loan, the Debt Service Coverage Ratio loan. So for example, if your mortgage for that property is $2,000, the potential rental income needs to be $2,000 or more. In some cases, you could make the rental property could make less, but it's rare, right? There's different guidelines to it. So if you ever see somewhere that says DSCR ratio, 1.0, all that means is that the mortgage payment is $2,000 and the potential rental income is $2,000. It's a 1-to-1, it evens out, right? Or let's say that the rental income is $2,500, then you will have a 1.25% DSCR ratio. Okay, that makes sense. So again, these lenders are doing their due diligence as well to make sure you're buying a cash flowing property, and it kind of gives you some slack where a lot of times as an investor, the most difficult part is not necessarily finding the cash, because either if you're joining to buy this property with other people, that's the first thing, right? You're doing all your due diligence, you're running all the comps to make sure that this property is going to cash flow. They're going to make sure it does it as well, right? Because they're going to be liable for it, and they don't even know how much money you actually make, right? They don't even care. So these are some of the guidelines for this, and it's very quick, and I'll break it down for you guys. Use the higher mid score of all the borrowers. Great. So when you're buying a regular conventional FHA, Fannie Freddie Mac loan, it's called a QM loan, they're going to take the lower of the two borrowers' middle scores, right? But for this product exactly, they're going to take the higher. In a lot of cases, I had a client the other day, The wife had a 780, the husband had a 670. Okay, we had to use his 670 score instead of his 780. For this product, we're gonna be using the 780, right? And that's a huge game changer. Next is FTHB, stands for first time home buyer. So first time home buyers is accepted, no mortgage experience needed, or excuse me, no management experience needed. So the reason why they emphasize this is because a lot of non-QM loans, they don't like giving it out to people that has never purchased real estate before or has never managed a rental property before, right? Because again, the way that they're going to mitigate their risk, right? Because everyone that's going to be lending out money, and that's the way I like to look at any type of lending, right? If you have to put yourself in their perspective, okay? So if you're someone with, let's say, $1 million, and you're going to give out $500,000 to a potential client who wants to borrow that money to purchase a piece of real estate. Again, in most traditional cases, it's saying, hey, let me see how much money you make. Let me see all the debts you have, and can you pay me back from this loan? In this case, the lender is not looking at that, so they don't really know. It's a lot, they're in the they're blinded, right, coming into this. So the only way they know they're gonna get their money back is that, in their minds, they say, hey, if this property is gonna be grossing over $500 a month, right? And then this buyer is giving me over, 25, 30% down already. That means you already have skin in the game. The probability of the buyer, foreclosing on the house it's rare. But even if they do, they still have 30% of your money, and they could just sell the property, right? Because they already make sure the property is cash flowing. They already make sure that the property is valued at this amount. Okay. So again, with this loan, they're gonna look at the rental income. They're gonna look at the mortgage payment. They're also gonna look at credit score. Is very key in a lot of non-QM loans. They want you to have excellent credit, right? Excellent credit could be anywhere from 720 plus. Okay. No reserves are required. This is rare as well because a lot of DSCR loans require reserves. When I say reserves, that's basically the money that's left over in your bank. So if you put a down payment of $50,000 and they say, hey, we want at least 3 months reserves, you have to have 3 months reserves of your mortgage payment in that account. If you use all your money to buy the property, that's a problem. But with this loan, it doesn't matter. Because in a lot of cases, again, with business owners, they have multiple bank accounts. So if they're using one bank account for the down payment and closing costs and whatnot, it doesn't matter if it goes down to $100 in there because there's no reserves required. Okay. Next, we're gonna go down. Max is 80% purchase. That is huge. That means that the minimum that you need to put is 20% down. Okay. So when you see an LTV, loan to value, at 80%, just think about the inverse, right? If it's 80% loan to value, that means they're giving you 80% of whatever the value of the property is. That means that the other person, which is you, is going to be giving the other 20% to cover the difference. Okay. So again, different lenders, different products, different credit scores will determine your LTV, which means the amount of down payment you need to put for the property to purchase it will determine based off those credentials. Okay. No ratio purchases under 65%. So basically what they're saying is if you're giving more than 35% down, they don't really care if the property is really cash flowing, right? Let's say you're someone with a ton of cash and wants to park your money in real estate, and you don't know what to do. You don't qualify for a regular conventional loan, and you can't find a property nowadays, which is extremely difficult, that's cash flowing well. They're saying, hey, if you give us 35% up front, we don't really care how much this property is making. Again, because you have skin in the game. They already have 35% of your money. They're just gonna take it. If you foreclose, cool. They'll sell the house. They have your money plus the home that they just sold. Okay. 1 month bank statement for closing cost. Pretty self-explanatory. Short-term rentals accepted. This is very, very important. So here in the Central Florida area, I'm sure many of you are familiar with Disney, and there are many short-term rentals near Disney. Okay, so when they say short-term rentals accepted, that means that they're taking the ratio of what a short-term rental would make. Because we know that someone renting their property out long-term compared to someone who's renting out their property short-term, the person that's renting out their property short-term is going to make significantly more money than the person who's going to be renting out the property long-term. Okay, so they're going to take the ratios on the potential rental income on the short-term rental compared to the long-term rental, which benefits you because you have a higher DSCR ratio, which helps you qualify a lot easier. Entity closings permitted, basically stating that you can close under your business name, right? You can close under your LLC. You do not need to use your personal name. Okay, so if you have multiple people purchasing a property and you want to buy it under one LLC, you could close under this name. So that LLC is the owner of this real estate. Condo hotels and no minimum square footage required. Loan amounts up to $3 million. So you could buy condo hotels, again, with no minimum square footage. And the reason why they put this is because, again, a lot of products scrutinize on a certain square footage it needs to be, and they don't want to do condo hotels, right? Because HOAs and the value doesn't increase as much. Loan amounts up to $3 million. So it's a huge cap there, right? So you have up to $3 million where you could purchase a property. So this is cash flow DSCR. There are many different DSCRs. Keep in mind, nothing in life is free. If it sounds too good to be true, then it is, right? This product offers a lot of incentives. It offers a lot of help for people, again, that can't qualify traditionally and have a lot of cash. But the caveat is always that obviously down payment is going to be higher, as you've seen, 20, 25, 35%. And the interest rates are slightly going to be higher, okay? I won't say 11, 12%, but let's say general rule of thumb, maybe a whole percent or 1.5% difference from what you qualify in a traditional loan, maybe more. It all depends, again, on credit score and different things. So it's a case-by-case basis. This is why it's important to say, okay, hey, I think I could qualify, or hey, I think my client could qualify. Let me get them on the phone with Jeremy to see, what the rates will be and see exactly in detail, what they're qualifying for. The next product, which I've been using a lot lately, is a 12-month bank statement loan. Cool thing about this product, specifically from Acra, their minimum FICO is 575. To put that in perspective, the minimum FICO for most FHA products is 580. So they're going 5 points below that, okay? Loan amounts either from $100,000 to $10 million, okay? Up to 90% LTV. You guys know if it's 90% LTV, that means 10% down from you. They allow W-2 and self-employed hybrids. What does that mean? Exactly what it says there. If you have a W-2 job, but have a business as well, we could use both of those bank statements, right? I could use your personal bank statements and your business bank statements. So what a bank statement loan basically does is takes the average of the 12 months of deposits that you put into your account and average that out as a monthly income, right? So again, for example, and this is a client that I had recently, she written off a lot of income on her tax returns. Okay, so by doing that, it hurt her qualifying wise, right? So what she had to do was, hey, if I'm depositing over $8,000 a month, but if I go the traditional route, it only shows that I'm making $3,500. I'd rather do the $8,000 a month. She has the cash, right? They have over 10% down to put on the property. They are first-time home buyers, right? This is the first home that they're purchasing. They still qualify. No reserves, 75 LTV. These are things that are key. Okay. 1 year self-employed program or borrower's program. A lot of times, whenever you're self-employed and they're looking at your income, they want to make sure you have at least 2-year work history, right? 2 years of owning your business. Here, all you need is one. There's a conventional loan where you only need 1 year, but this one is just 1 year self-employed as well. Okay. This is full doc and going bank statements as well. Profit and loss statements. So the way I like to look at these things are, you have your 1099, you have your DSCR, you have your bank statements, your profit and loss. in most cases, I look at the client's situation, right? If they're depositing more in their bank account compared to what they're receiving in 1099, I usually go the bank statement route because the rates may be more forgiving and the down payment may be a little bit more forgiving, or credit score, right? Again, it's all on a case by case basis. So the profit and loss, we're just looking at your profit and loss statements, okay, on your business. And this is something you could do, or I would always highly suggest that you have your accountant do the profit and loss statement for you. Minimum FICO is at 600. The LTV is 80, again 20% down. Loan amount to 4 million, and you could get these prepared by these three entities: your CPA, P10, your CTEC, right? They could prepare that for you. Bank statements not required to support your P&L revenue, so they're not going to scrutinize your bank statements to make sure that everything you're making is getting deposited into your business bank account. All right, all occupancy types as well. Awesome. Last thing I'm going to touch on, the 1099 only, and this is very popular with a lot of realtors, okay, because a lot of them receive 1099, and let's say they made 350 grand that year, but Uncle Sam he only paid Uncle Sam $50,000 worth of taxes, right? He only tax liability of $50,000. So income earned via non-employment, such as a freelancer or contractor, right? I am a contractor myself in mortgages, right? So I do file for 1099. So this program specifically is FICO starts at 600, so you need a 600 credit score. LTV is 80%, 1 year 1099 and 2 month bank statements. So we don't need the past 2 years. If you crushed it the previous year, we'll use that 1099 statements. If you made 250,000 plus, we use that 1099 statements, and then we'll look at your 2 month statements to make sure that that money is actually getting into your account. I know there's a lot of information to digest, and there's many different non-QM products that we offer, and different lenders that we do offer. Again, it's just one specific lender. I just use them because they had the PowerPoint right in front of me, so might as well, take advantage of it. But if you guys have any questions on these products or want to pick my brain on different scenarios, let me know. I'll have my email below and my number if you guys want to reach out. Thank you.